ETFs are popular for their versatility and ease of trading. They provide a cost-effective way to diversify and get professional management. They are great for retirees and anyone needing both income and inflation protection. So if you're looking for a steady stream of dividend income and long-term growth potential, check out these 4 high-dividend yield ETFs. SPDR Blackstone High Income ETF, HYBL. This is a high-yield bond fund, sometimes referred to as junk bonds. But despite the association with higher risk, this fund offers investors a more secure way to tap into the high-yield bond market thanks to its professional management and broad diversification. The fund doesn't just focus on high-yield corporate debt. It also includes senior corporate loans and collateralized loan obligations in its portfolio. CLOs are bundles of individual corporate loans turned into bonds by investment banks. While the average investor may not directly own CLOs, they are highly favored by institutional investors like insurance companies and pension funds. HYBL employs a top-down strategy to decide which asset classes to invest in, but it uses a bottom-up approach for selecting the individual securities. This means the fund's portfolio managers first assess the broader economic and market trends to guide asset allocation, then choose specific bonds based on in-depth credit analysis. This detailed, hands-on management contributes to the fund's 0.7% expense ratio. Its trailing 12-month yield is 8.2%. Number 2, Invesco High Yield Equity Dividend Achievers ETF, PEY. Dividend growth investing is a simple strategy. As a company increases its dividends, its stock price usually rises. PEY, a $1.2 billion index ETF, is an excellent choice for those focused on this approach. The fund tracks the Nasdaq Dividend Achievers 50 Index, which includes the top 50 highest yielding stocks from the broader Dividend Achievers Select Index. Both indexes feature U.S. companies that have consistently increased their annual dividends for at least 10 years straight. PEY's investment strategy focuses on stocks with strong financial health. Companies that can consistently raise their dividends typically have confident management and solid prospects, offering investors reliable stability. While PEY isn't the cheapest ETF, with an expense ratio of 0.52%, it provides good value because of its focus on high-quality dividend-growing stocks. Its trailing 12-month yield is 4.7%. The third ETF, iShares 20-plus year Treasury Bond Buy Right Strategy ETF, TLTW. Long-term Treasury bonds can vary in price with the fixed income market, but since they are backed by the U.S. government, they are generally seen as a conservative investment. TLTW is a different ETF in that it offers a more aggressive twist on this traditionally safe asset class. TLTW tracks the CBOE TLT 2% OTM Buy Right Index, a unique benchmark created just for this fund. It invests in the iShares 20 Plus Treasury Bond ETF TLT and earns income in 2 ways. First, dividend. TLT provides a steady cash flow with its 12-month trailing yield of 3.8% from a fund with over $50 billion in assets. And 2, covered call premiums. TLTW boosts its income by selling covered calls on its TLT shares, adding another layer of revenue. With expectations that interest rates will soon drop, driving up TLT's price, TLTW is able to sell covered calls at very high premiums. This market condition significantly boosts the ETF's current yield, making it particularly attractive right now. It has a trailing 12-month yield of 15.5%. And finally, SPDR Portfolio S&P 500 High Dividend ETF, SPYD. SPYD is a spin-off of SPY, the original ETF for retail investors. It tracks the S&P 500 High Dividend Index and has over $6 billion in assets. This special index includes the 80 highest yielding stocks from the S&P 500, making SPYD a go-to for high dividend income. Smart investors with Appreciate SPYD's ultra-low expense ratio of a mere 0.07%. This minimal cost helps the fund closely mirror the performance of its benchmark, making it a smart choice if you're looking to maximize return while keeping expenses low. The ETF is perfect if you're looking for a solid mix of income and growth. It has a strong track record of delivering impressive long-term capital gains while offering higher dividend income compared to other large-cap funds. So you can confidently include SPYD as a core part of your investment portfolio. Again, it has an expense ratio of 0.07% and a trailing 12-month yield of 4.3%. Now that you know the best high-yielding dividend ETFs, you should check out my video on the secret to successful dividend investing right here, linked also in the description. Don't forget to like, share, and subscribe to Financially Well. Share your thoughts in the comments below. And until next time, stay financially savvy. We'll see you in the next video.